Good morning and welcome this morning to Cryptocurrency Basics, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out here today in this webcast by my oftentimes compatriot in this particular webcast, Jim Ferrioli, Director of Cryptocurrency Research and Strategy at the Schwab Center for Financial Research. I'm also joined out in the chat by Kevin Horner, who is a nearly 30-year veteran of the financial markets and a great educator. He's going to be there to help facilitate the conversation and keep that chat flowing. If you're with us in the recorded version, thank you for being here. We appreciate you joining us. Leave us a comment in the comment section, but chat in your questions as we get into this discussion. And so before I bring Jim on to this discussion, I wanted to say one thing really quickly, and that is reiterating what we talked about last week. If you weren't here with us last week, that's why I'm repeating it this week. As we now have two complete cycles of the Cryptocurrency Basics webcast content recorded and archived and available for you, our focus is going to shift a little bit from the static content of how and why and what to what's going on right now. So the focus is going to be a little bit less on those basic ideas and a little bit more on the current market conditions and strategy and ideas that are happening in the cryptocurrency world. So we're going to jump into that discussion today. We talked a little bit about more market commentary last week. We're going to talk a little bit more about market commentary this week, along with Jim in this discussion. So a couple of quick, however, housekeeping items, and then we'll jump right into the content here. Remember that everything that we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or a solicitation of a particular type of strategy or a security or an account type. We're going to use some technical analysis in this discussion today. Schwab doesn't recommend the use of technical analysis as sole means of investment research. Now, here's the important part. Digital currencies like Bitcoin are highly volatile. They're not backed by any central bank or government. It's important to remember that those digital currencies lack many of the regulations and consumer protections that legal tender currencies and regulated securities have. That makes them a speculative instrument. That also suggests that the ideas and concepts and regulations and concerns around these products are still developing and are not fully known and have not fully emerged. So it is a dynamic circumstance. So make sure that you are aware of the fact that things may change. Additionally, cryptocurrency related products carry a substantial level of risk. They're not suitable for all investors. Make sure that you are absolutely aware of all of the concerns as they exist at the time around cryptocurrency products before considering trading or investing in any of these strategies or ideas or symbols. As we get into this discussion, we'll talk specifically about, because we've been placing some illustrative example trades, we'll talk about the concerns and considerations around those trades. We're going to be using the Thinkorswim desktop software platform in order to do that, specifically the paper money version. Paper money version is a great learning environment. It is not, however, a guarantee of future success out there in the real world. And it does not do certain things that a live trading account will do. A lot of that has to do with scans and searches or with options, but one of those that you may be concerned with as you move your practice from paper trading to live trading is that paper money fills orders typically at an algorithmically derived mid price between the bid and the ask. Whereas in a live trading account, an order is likely to fill based on current market forces, which may not be at the midpoint of that order. Also, when we put things like stop orders in, make sure that you understand that there is no guarantee that the execution of a stop order will be at or near the stop price. So with all of that in mind and those caveats ringing in our ears, Jim, let me bring you into the discussion. Jim Ferrioli, Director of Crypto Strategy and Research at the Schwab Center for Financial Research, otherwise known as Skiffer. Hi, Jim. How are you this morning?
Hey, Ben, I'm good. Thanks for having me on again.
You bet. So we've talked in the last 8 weeks now, what it ultimately has been 9 weeks, if you add the one that we did last week. We've talked about these four things. What is cryptocurrency? How does cryptocurrency work? How do people get exposure to cryptocurrency? And what drives cryptocurrency prices? Where we are on that rotation in terms of some of the basics right now is kind of this idea of how cryptocurrency works. And that brings us into this topic, Jim, of blockchain basics, proof of work versus proof of stake, which is going to be an interesting comparison because of one of the things that I want to talk about when we get to the market commentary section today. And then I know some questions have come up just in talking with clients around the country about wallets and exposure to cryptocurrency. So maybe we jump into the discussion here, Jim, at this point with this understanding of crypto and blockchain and just talk a bit more about what is a blockchain.
Sure. So a blockchain is a distributed ledger. It records transactions. It's maintained by no central authority. Cryptocurrencies are the native currencies of these blockchains. And so Bitcoin is the original blockchain. It was launched in 2009. And Bitcoin is also its native currency. So it was launched as a payments network. There are other types of blockchains, such as Ethereum and Solana, which have a bit of a different use case. But ultimately, all they are is it's a distributed ledger, and every single block is just the most recent batch of transactions that have occurred on that network. Within each block is a historical record of every block that records the transactions from those 10 minutes. And so again, you're literally chaining together a series of transactions to create a history of transactions. And so if we think about how this works, a transaction occurs when you send a message to the blockchain. At that point, participants on the Bitcoin blockchain called miners, they race to solve a code, and the ultimate output, if you create the right output, you generate a new block of transactions and you're rewarded with Bitcoin. And so again, the blockchain is the record of transactions. It's a public ledger. It's designed to be secure, transparent, and accurate. And again, it doesn't require a central authority. You have different participants in the case of Bitcoin miners, in the case of something like Ethereum or Solana, validators. They're all independently competing against each other. And that's what
Right.
keeps the blockchain secure and honest and not needing a central authority. They also have their own economic self-interest. You want to maintain an accurate version of the blockchain because you're paid in the native currency of the blockchain. If people who use the blockchain were to lose faith, they didn't think you are maintaining an accurate version, the value of that currency would fall. So again, it's in their own economic self-interest to secure and maintain an accurate version of the blockchain.
So Jim, one of the questions has come up, and I know this is something that a lot of people maybe have not necessarily thought the process through, but blockchain transactions, those transactions that exist on the ledger, aren't just credit card receipts, right? Or credit card transactions or financial transactions in money transfers between one entity to another. They may be things as far flung as a blockchain track on, say, for instance, property records, correct?
Correct. So there's different data that can be stored on blockchains. Bitcoin is primarily used as a payments network, but you actually can store um, through a process where you can store kind of images as well. That's more prevalent in other blockchains such as Ethereum and Solana. And this is referred to as tokenization, where you're actually applying a blockchain record to a real world asset. And so again, it's a way to create a liquidity, a more liquid market for some assets. It's a way to track assets, have them settle faster. One of the emerging use cases, and that's really gained traction in recent years, has been tokenizing equities, right? If you can do instant settlement with the tokenized stock, this is happening outside the US, to be clear. there's benefits there. So it's not just cryptocurrencies that are tokenized. It's not just transactions. And so what we see is in instances like Ben mentioned, where it may be tokenized real estate, a tokenized money market fund, the value that the asset is still traded, you transacted on chain, and you
Right.
would use the native currency to initiate the transactions. And so you still need the currency to interact with the blockchain itself.
Interesting. And so I think, this is one of those areas when I mentioned in those disclosures that things are changing. Things are definitely changing quickly, primarily, as you again, I'm going to go back to that outside the US. But you're seeing changes happening in that tokenization world. And this is why I think, from the standpoint of our attendees in this webcast and from those that are interested in cryptocurrency in general, understanding that there are possibilities to be unlocked through this tokenization prospect that we haven't really even thought of yet in terms of tracking, pretty much anything. In terms of now, as we start to get into, I think about this particular use case, Jim, and it is this. One of the concerns with AI and the AI build out is ownership of digital property rights, right? So maybe you're an artist and you create a song, and then somebody comes along and creates an AI version of that song, and it's a little bit different. And then there's a dispute as to who created it and who has ownership. So a blockchain tokenization process could be a solution to that type of property ownership, correct?
Exactly. And as an example, this was prevalent in 2021 with what were called non-fungible tokens. And in
Yeah.
this definition, I would describe the rights to a song you produce as a non-fungible token. Now, at that point, people were attaching it to kind of just images, memes, things like that. And right. And so those are kind of low value usage. But you can see that through a blockchain system, it does create a method where you can assign scarcity to something that's digital in nature. So digital networks, it's hard to have anything scarce, right? Anyone owns,
Yeah.
anyone can access a song if it's available online. Anyone can access an image if it's available online. So again, assigning it to a blockchain and having this tokenized proof of ownership is again, it's a way to create scarcity. And so again, moving away from the very speculative idea of tokenizing memes, but into real world use cases such as IP rights,
Yeah.
maybe uh, books, right? Things you've written, uh, maybe music you've produced, things like that.
Sure. And code, right, that's generated. I mean, any use case in terms of that IP or intellectual property idea. So one of the questions that just came up, and we're going to get to a couple of other, there's a couple of wallet questions that I want to address here as well. But one of the questions that came up was this idea of halving, and we've talked about halving, in terms of the concept of proof of work. So I think this is a timely question given this particular slide and where we are in this discussion. The idea that that reward that miners receive for validating the blockchain isn't a fixed reward. That amount changes um, over time as a means to keep that scarcity in place, right?
Correct. So the Bitcoin blockchain specifically, it's been designed to only ever issue 21 million Bitcoin. And currently, about 20 million are issued, and it's estimated about anywhere from 4 to 6 million are lost and non-recoverable. Every 10 minutes, a new block is uh, processed. And so what that means is the miner that produced the correct output is rewarded Bitcoin. And so again, these miners are constantly competing against each other to try to earn this block reward. That's their economic incentive to maintaining the security of the blockchain. Every 210,000 blocks, which is roughly every 4 years, the amount of Bitcoin that's rewarded to miners per each block gets cut in half. And so Bitcoin has a disinflationary supply growth in that the amount of Bitcoin that's issued every year relative to the outstanding supply of Bitcoin is constantly growing at a slower rate. And ultimately, over time, you get to a point where there's actually no more new Bitcoin being issued. And so miners are compensated with a share of transaction fees. Um, so this is important because it results in a supply constrained asset. The core long-term driver that we've identified for Bitcoin is the US money supply. In general, over the long term, money supply has grown about 6% a year. And
Right.
so if you think about that, there's been relatively, again, over Bitcoin's 17-year history, over the long term, more or less steady demand. Every year you have some new investors in it, but generally you have the same people that were purchasing it or mining it in 2009. They're still trying to acquire it today. Now it gets impacted in the short term by things like macro interest rates and certainly is volatile. But again, over the long term, it's been relatively demanded. So that means you have an expanding stock of money, right? That's why we invest and in anything, right? You want to
Sure.
maintain the buying power of your savings. So you invest in things like stocks or bonds or real estate or cryptocurrencies, right? And so Bitcoin has a fixed supply. So over the long run, um, assuming that demand remains relatively stable, there's going to be this permanent mismatch. But that also means that the rewards to miners are cut in half every 4 years. And so what that actually means for the validators is the costs to produce a Bitcoin uh, roughly double every 4 years. And so again, when we think about valuing Bitcoin, there's kind of two ways to think about it in the short term. There's this scarcity implied value, right?
Right.
There's a mismatch between supply and demand. That's more prevalent in bull markets. In bear markets, there's what we call the energy barrier, the electricity costs to actually produce the Bitcoins. And so again, that's probably more in line with where Bitcoin's trading more recently. But so that's the concept behind the halving. It's a way
Sure.
to keep the miners involved. It's a way to artificially essentially support prices. If you think that Bitcoin should trade over the long run at the above the cost of producing it, again, it kind of provides a floor there.
So I want to ask this question. I mean, I know that there's the algorithm that determines the halving and the rate at which those halvings occur. Is that a fixed rate or does that accelerate as we get towards the terminal point of the total number of Bitcoin that are available?
Yeah, it's a fixed rate. The future issuance of Bitcoin is completely known. Every 10 minutes, you'll get a new
Yeah.
block reward. So currently, the block reward is about 3.125 Bitcoins per block, right? So every 10 minutes, that's the amount of new Bitcoin that's mined. After 210,000 blocks, and the latest halving occurred in April of 2024. So the next one will be in, sometime spring 2028. Um, that 3.125 will get again cut in half. And so we know every 4 years, we know every day on average how much Bitcoin will be mined. Now, to be clear, the blocks aren't produced exactly every 10 minutes. There's a
Right.
method on the blockchain, and this is important in the short term, called a difficulty adjustment. If a lot of miners join the network because maybe prices are high, that could actually result in Bitcoins being mined too soon, right? And so there's a mechanism that will make the algorithm that they have to solve more difficult to solve, which is why it's called a difficulty adjustment. And so again, on average, you would then see after a difficulty adjustment, maybe the block rewards are now happening on average every 10 minutes. The same thing happens if they're occurring too slowly. Sometimes when prices fall, um, the it's still too difficult to mine. There's too many miners on the network. And so it will actually make it less difficult to solve the algorithm. Let me rephrase that. When miners leave the network because prices are falling temporarily, there's this mismatch where it's now too difficult to mine the network. And so again, they'll make it less difficult to get more miners on, and that ultimately kind of balances out back towards that every 10-minute block. So in the short term, there's kind of a variability, but over the long term, it tends to be more stable. And over the long term, we know kind of the forward issuance of Bitcoin. It's set in stone.
So, at the risk of going down a rabbit hole, Jim, I'm going to ask this question because I think it's a relevant question because it's coming from, we're getting this coming from our attendees. Are we going to run, as we get to that point of issuing the last Bitcoin, right? That last Bitcoin um, is rewarded. Are we going to run into this Zeno's paradox where we could subdivide that rate of issuance of Bitcoin infinitely, right? So you get, if you're thinking about moving towards a goal, if you were to take half a step towards that goal and then, half a step again and half a step again, it becomes reductive to the point where you'll theoretically never reach the goal, right? Because you're always decreasing the distance between you and the goal again and again and again. Do we get to that point? What happens at that singularity of the last coin being rewarded?
So that's a good question, and there's actually a measure. It's called a Satoshi. You can subdivide
Yep.
a Bitcoin, and so like essentially once you get to like the smallest denomination of Satoshi you can, that's the final reward. And so it's in 2140. Thankfully for me, I won't. I'll hopefully at that point be retired. It,
Yeah.
if
We
I can live,
probably
if I
won't. So what
if
you're
I
saying is
c-
we don't
if
have to
I
worry about it.
yeah, so it won't necessarily be an issue for me. I probably won't, even be around at that point. But the jokes aside, there is a hard stop. So 2140, the last Bitcoin will be mined, and it's important to know that because while the miners receive the block reward of about 3.125 Bitcoins per block, they also get a share of transaction fees. And so,
Okay.
um, anytime you do a transaction, I want to send Ben some Bitcoin, there's a transaction fee. And so that gets paid to the miners. And so that can be anywhere. If there's a period of peak demand, it could be maybe over $1 million per block. In periods of lower demand, maybe 100,000 to $200,000. Right? It depends on how much network demand. But
Sure.
the idea is that in the long term, assuming the Bitcoin network continues to grow, the economic incentive for the miners will be to receive the transaction fees, and they'd be large enough at that point that it's not an issue to not receive the Bitcoin as a
To not
reward.
receive new Bitcoin,
Yeah,
just get the transaction fees.
yeah,
Okay,
and
cool. So go
quite
ahead, Jim.
frankly, at periods right now, it's still a good incentive. It's just like when the networks kind of slows down, there's less activity right now. Again, it
Sure.
might be less of an incentive now.
And that's one of the things that puts in when we start getting into driving Bitcoin prices. One of the things that drives those Bitcoin prices is when Bitcoin price of spot Bitcoin gets down near that average cost to mine, and there's an arbitrage there between mining new Bitcoin and trading Bitcoin that's already existing, and those miners, those large scale miners will play that level of that Bitcoin or that mining cost. So
Oh,
that's the
100%
proof of work side, right? This is the proof of work side, correct?
correct.
Okay, now let's shift our focus, Jim, a little bit to the proof of stake side of the discussion because I think this is an important consideration.
Yeah, so Ethereum uses a different validation consensus method called proof of stake. It's much less energy intensive, and it's a little bit differently. And so essentially, what validators on the Ethereum network do is they pledge some of their Ether in an escrow account. And so they say, hey, this is the correct version of the blockchain. They're still competing to see, who will earn it. And ultimately, if they put their Ether up and it turns out they're not submitting the correct version of the blockchain, they lose the Ether they put in escrow. So again, it's
Okay.
economically self-reinforcing. If you're putting Ether up, you want to put the correct version of the blockchain up because ultimately then you receive more Ether as a reward. So again, they're doing it for their own economic self-interest. And so that's how it ends up being a less energy intensive process. There's actually very low energy costs relative to Bitcoin. With Ether, the more Ether a validator holds, there have been criticisms that it does maybe make the case that they have a little bit more power. So it is that people would say that the validation is a method is a bit more concentrated, but there's a lot of blockchains that have adopted this, and it actually allows for much faster transaction speeds relative to Bitcoin. So there's an additional benefit there.
So it could be equated to, for instance, we are back, it appears, and we apologize for those technical difficulties. It seems that we're back up again. So I just want to go back and reiterate what Jim were discussing as we're talking just amongst ourselves at that point. So, Jim, we're talking about the idea that investors, retail investors, institutional investors, both are yield-seeking creatures, right? We tend to go to where the yield is, whether it's dividend yield, whether it is treasury interest rate yield, whether it is individual stocks that are moving higher because they're paying their capital appreciation is happening. So that same thing happens here in Ethereum as a proof of stake because there is that opportunity. So if investors are moving into Ethereum for that return or that yield, and that yield drops off, they could rotate someplace else that's paying a higher dividend or a higher yield. Correct?
That's correct. And that's actually one of the self-reinforcing things that keeps Ethereum validators on the network. The more there's a fixed amount of Ethereum that is, given as a reward for validating. And so the more people that are
Sure.
on the network in the validator process, right, that means less percent for everyone. If people are selling because there's a bear market and you're seeing validators leave the market, that means there's a more share of ether that gets paid out to these validators. And so again, it ends up being this like economic self-reinforcing process, whereas as the validators leave, it's more ether for the remaining ones. And so again, similar concept to investors seeking yield,
Yeah.
where the validators, that's kind of their self-reinforcement. Did we lose the stream again?
I think we're good again. I think we're still good. Okay, cool. Yeah, good, good. Yeah, and so when we talk about some of the things, and this gets back into the kind of the market commentary element of this discussion, when we talk about things like interest rates for US Treasury bonds going up, like we've seen recently, that may be an incentive for investors or validators in this particular case to move out of Ethereum validation and into something else in a short term that's paying a higher yield. But then, as you just mentioned, the cure for that is that then those that are remaining are getting paid more. Therefore, it becomes more attractive. And so as those two change, that arbitrage tends to keep that yield relatively consistent. Is that right?
Yes, and I think I think there's going back to the treasury
Hmm.
interest rate example. I think it's a good way to think about how validators earn yield on their ether. But I think it's also important to make a separate there that I would not bucket ether or any other proof of stake cryptocurrency as a fixed income investment.
Sure. No,
Most
absolutely.
investors go to those for interest relative price stability. And if there's one thing cryptocurrencies are not, it's price stable.
Sure. Oh, absolutely. Okay. So, Jim, let's pivot a little bit, and then I want to get out to a couple of charts here really quickly. And that is this idea of where is my cryptocurrency held, this idea of a wallet, because some of the questions are coming out in relationship to some fairly highly publicized attacks and hacks on wallet technology in the last little while.
Yeah, great question, and it's very timely as there's actually an attack that's been going on since Friday on some Bitcoin wallets. And so it's really important to point this out is that uh, blockchains, and I'm saying specifically here the Bitcoin blockchain and the Ethereum blockchain, are very secure and hard to hack. The larger a blockchain network gets, its security becomes kind of self-reinforcing. The resources needed to take control of that network and create adverse transactions just they become really kind of unsurmountable. And then there's this idea of kind of what we talked about earlier, where it's the validators of this network, they're economically aligned with the network itself. If you wanted to take down the network, it would cost you a lot of money to build the resources. So again, it's a kind of a self-defeating purpose unless, you don't just your method is to just destroy the networks, or rather your
Right.
goal. And so when you hear of hacks, it typically happens either at an exchange or at a wallet. And so these are the connections to the network. Now, what a wallet is, they access private keys. Public keys are available, and all the cryptocurrency is actually on the network. It's just a record of who has what. Think about it like this. A public key is similar to an email address. If I know someone's email, I can send them something. I can't access their emails without their password. And so a password is similar to a private key. And so what you store in a wallet are private keys that gives you access to Bitcoin that's stored at an address. And so again, when you hear about hacks, it's people that are getting access usually to private keys. So what's been happening over the weekend, this is a small provider of hardware wallets. Um, they used a random number generator to produce their private keys and seed phrases that actually inform is where the private keys are built from. And they ultimately used a poor version of this that hackers were able to figure out and then crack. And so this is very specific to that issuer. This isn't a broad-based hack on the Bitcoin network. And so it's important to be clear, but that's why it's important to understand kind of the different wallets and the different security features. You have hot wallets, they're always connected to an exchange. They're less secure in that if you got exposure to the exchange, right, maybe you could hack it through there. They're more convenient if you're an active trader. A cold wallet, now a properly built cold wallet has much higher security and is much less convenient. And so I really want to iterate the issue that's going on in these, and there it's a wallet specifically made only for Bitcoin, is the the issue is with the wallet provider themselves. They had a faulty upgrade to their wallet software back in 2021, and they never realized it. And so again, in general, cold wallets are more secure if they're made correctly. But the weaknesses on the network always tend to be on the connections to the network, not the network themselves.
And I liken this, Jim, to obviously the development, if you want to think about it from that standpoint, the development of, let's say, bank vault technology, right? You had bank vaults in the 1800s that were able to be broken apart with a crowbar because it was cold rolled steel and it was brittle, and so you could break that apart. And then they developed different technology to lock those vaults to defeat those that were trying to defeat the vaults, and that process and that cycle continues. And this is simply the same type of escalation. When vulnerabilities are found, those vulnerabilities are exploited, those exploits are patched, and then on and on it goes. This is the nature of cybersecurity as it exists. And to, to that point, Jim, I think this also drives kind of that larger cryptocurrency halo. When we talk about it, gaining exposure to cryptocurrency, one of the things that traders might not think about is the influence that circumstances like this might have on cybersecurity companies.
Oh,
Palo Alto Networks, for instance, and others like that, right?
for sure. I mean, the core technology behind cryptocurrencies is cryptography, and so securing and creating privacy. And so there's a lot of innovations that have actually come out of cryptocurrency that have now been applied to kind of other areas of security. And so it's really important there. The other thing I'd point out is again, and I don't want to drone on too long here, is this is a public blockchain. And so
Sure.
even though that there is a hack going on, it's visible. You can see where all the funds are flowing. And so um, in previous instances of hacks, sometimes there's ways that investors have been able to get their funds back. I'm not saying that that will happen this time, and it sometimes can take many years. But you have a public
Sure.
blockchain, you can see where the funds are moving to. Once the attackers try to remove them, depending on where they try to remove them from, they could get frozen at an exchange or wherever their offboard is. And so not guaranteed to happen, and it often takes many years to receive funds back, but it doesn't necessarily mean those that were impacted in this latest hack will never get, their money back. They
Right.
may.
Look, you can store your cash under the mattress, and it's probably going to be as secure as you make that mattress, but it's going to also be suffering from decay of paper and mice chewing on the paper. I mean, that type of thing, right? So there's never one ultimate, exquisitely, specifically secure circumstance. I mean, there's always an exploit and there's always a patch, and that's the way that that process goes. So I wanted to pivot here, Jim, to what's going on here in the market at the moment, and we've got a few minutes left to talk through this. And I've got on the chart the continuous contract for Bitcoin. This is the futures contract. Now, we're not using the futures contract in this context to trade. We're talking about this in terms of its movement relative to market forces. And we've seen Bitcoin in the last 6 months or so hovering fairly near this range between $60,000 per Bitcoin up to a high in this range of about 82,000 per Bitcoin, but kind of running in the middle of this range, kind of around this 66 500 level or so. And one of the things that we know is that that kind of falls right in line with the average cost to produce a Bitcoin, right? So this is not trading at necessarily premium to production, nor at a significant discount to production. And this is perhaps what's referred to as a crypto winter, yes?
Yes. So crypto winters are historically deep bear markets. In the past, we've seen them go as deep as 75, 80, 85% drawdowns from their peak. That was obviously coming from a when Bitcoin was a much smaller asset. Its volatility
Sure.
has dropped. But yeah, we estimate at the peak, right? Because during these drawdowns, the difficulty adjustment, which we talked about earlier, it falls. And so the costs to produce Bitcoin do fall. But we do measure from the peaks, and we do know that at around the peak, the best miners mined at about $60,000 per Bitcoin. And so again, we've found that historically that level tends to be where kind of you get your bear market support at. And so that's an important number to kind of track. And as proxy for it, you can look at what the public miners, though it's
Yep.
trailing, what they report their costs of productions are to kind of help feed that as well. And so we estimate it's about $60,000 today. That level has held. Another good technical analysis study that we find over the long term works as good long term support is the 200-week moving average. That's about $63,000 today. And so you can see that Bitcoin's held pretty well around that level as well. And so those are kind of two key levels that we track.
Interesting. And so again, we can use technical analysis here as a means to kind of tell what's going on. I want to do this real quick, Jim, because I touched on this at the beginning of the show and talking about the influence of interest rates. So what I've built on this particular chart is a comparison line and a correlation study to just one of the interest rates that many people are familiar with just from a retail standpoint, and that is the 10-year interest rate, because it governs typically now mortgages and credit cards, auto loans, those types of things that retail traders are most familiar with. And you can see that that purple line is the representation of the /10Y, which is the interest rate futures on the 10-year note. And it's been rising, and we've seen a breakout above some previous highs. So as that interest rate has gone up, again, going back to that kind of yield seeking and or money supply influences, which influences Bitcoin, you start to see that correlation now moves more towards an inverse correlation between Bitcoin and interest rates, correct?
Yeah, correct. And I actually really love this study because you can see the correlations over time.
Yep.
Over a longer term period, Bitcoin tends to be an uncorrelated asset, but in the short term, it gets impacted by all these things. And so, as interest rates rise, that can impact Bitcoin. And as you can see recently, right, the correlations are actually falling negative. So you're seeing
Sure.
a rise in higher rates is kind of you're seeing an equivalent fall in Bitcoin there. And so
So
um, always want to kind of know what your short-term correlations are.
So I want to go over here to Ethereum and take a look at, again, this is the futures contract for Ethereum. We're using as a market measure, not as a tradable instrument. If you are going to trade futures products, make sure you're aware of the fact that futures have significant leverage. They are not suitable for all investors, and they require a separate trading authorization. So now I'm looking at Ethereum versus the 10-year, and again, largely uncorrelated. But again, now coming into this scenario, we talked about that arbitrage between uh, Ethereum proof of stake yield versus the real yield of moving into, say, for instance, a government backed treasury bond. And so you can kind of see that inverse correlation as Ethereum has, or excuse me, as the 10-year has gone up. And quite frankly, Ethereum likely more sensitive to the shorter term end of the yield curve, the 2-year and others, but we're kind of in that middle of the road range here with the 10-year. But you can start to see that as yields go up, Ethereum starts to maybe move down a little bit. There are other forces at work, but this is simply one that is discoverable and chartable on the Thinkorswim platform.
Yeah, in general, cryptocurrencies are long duration assets. They don't have cash flows while you can earn yield on some of them. And so in periods where you're seeing rising interest rates, that typically we would expect that to impact kind of long duration assets, which I would categorize cryptocurrencies as.
And then one of the other influences, and I'm just going to change this correlation line here really quickly to the S&P 500, SPX. And we'll take a look at this in relationship, and I'll change the correlation study to that as well, because one of the things that you mentioned was the fact that this is largely an uncorrelated asset. And so, we talk about things like gold as an alternative asset to have in a portfolio. So some of the forces at work are that back and forth flow for investors. And again, it's yield seeking just on a different level of moving into the S&P 500 when the S&P 500 is running strongly, and out of uncorrelated assets because they want to take the winners. When that starts to pull back, you start to see movement into uncorrelated assets that are moving differently, correct?
Correct. Yeah. And as you can see, there was a period where Um, there's been periods where Ether has been highly correlated to the S&P 500. There's been
Mhm.
periods where it's been negatively correlated, and now it's kind of just showing kind of low correlation, no correlation. And so, again, and it's got different drivers, right? The S&P 500 is an index of stocks that is made up of companies that are growing revenue and earnings. They're implicitly impacted by the economy. Cryptocurrencies are not. And so again, different drivers, they can be correlated at sometimes, they can be uncorrelated or negatively correlated at others.
All right. Well, Jim, I know we're running up against time, and we apologize again for those technical difficulties, but I wanted to give you some resources before we jump out of this discussion. If you want to learn a little bit more about cryptocurrency at Schwab, schwab.com/cryptocurrency. If you want to catch the webcasts that we teach on a regular basis, including the ones that Kevin put out there in the chat. For those of you that are watching this in the recorded version, check us out over here on youtube.com/@Trader Talks webcasts. And that's where we're going to be able to find all of our crypto webcasts, including the short videos that Jim has produced talking about specific aspects of this discussion. And then you can find us as well on the Learn tab at schwab.com, including all of the written material and articles that Jim puts out on commentary on an ongoing basis. So once again, I want to thank Jim for being here. Jim Ferrioli, Director of Cryptocurrency Strategy and Research at the Schwab Center for Financial Research. I want to thank Kevin Horner for being out here answering those questions in the chat, and all of you for joining us as well. Our great production staff for helping us to get through those technical issues, and our great reviewers. We'll see you guys again next Monday for more market commentary around cryptocurrency basics. Thanks, Jim. Thanks, everybody. Take care. Bye-bye.